What's up guys, AC here, and today we're going to be talking about how to avoid blowing up your trading account. So there's 5 things that I want to talk about today, and the first one has to be risk management. It's really all about risk. Risk management, risk management, risk management. If there's one thing that a new trader can learn, it's how to manage their risk. Most of the time what happens is someone learns a new style and strategy and they're just excited to get into the market. The problem is you don't really know the ins and outs of the strategy, and so you don't really know the right entries, the right exits, and more often than not, you're just sizing too big, and so before you can actually figure out if it's a worthwhile strategy or not, you're just losing and hemorrhaging money. The most important thing that I tell people is usually you want to be risking less than 1 to 2% of your account for any individual trade. Now, in a new strategy, you oftentimes need to reduce this even lower. The best thing you can do is actually just size down. So even if it's only 0.5% or even 0.25% of your account in terms of risk, that is how you're going to really learn. Number 2, you have to have a trade plan. Now, most people will enter a position and they think that it can only go in one direction. They're like, I'm getting into this position, it's definitely going to go up, it's a bullish position, there's no way it can go against me. Now, the problem with that is, 1, you have no idea what to do when you're wrong, and 2, how do you determine to get out? Even if it's going in your direction, at what point do you start to think about taking profit? The problem with these 2 things are, 1, if the trade starts to go against you, you start becoming fearful. And most people will just let the trade run against them and think, okay, just give it a couple more ticks, a couple more days, and it'll come back, and as soon as I get to break even, I'll sell. The other side is, even if they get into a little bit of profit, they start to worry, oh, what if I give it back? Oh, what if the trade goes against me? So what ends up happening is they usually sell too early. Now, based on this kind of trading and thinking, what often happens is you have small winners and large losers. Now, in terms of a risk reward, it's the exact opposite of what you would want. Normally, you want a very tight, small risk, and you want high, risk reward with your winners. And so by not having a trade plan, you're already setting yourself up for failure. I can talk a little bit more about what kind of setups have good risk reward. I personally am a big fan of breakouts and episodic pivots. If you don't know what I'm talking about, there'll be another video linked in the description where you can check those 2 things out. And also Kullamägi.com is a great place to start with that kind of trading. Number 3, you got to learn to control your emotions. There's pretty much only 2 emotions that drive the stock market: fear and greed. Now, the problem is we're human and we're going to have these natural instincts. We're going to have fear and greed. So it's impossible to completely eliminate them. Instead, you should try and do, the things that we talked about already. By managing your risk, by having a trade plan, you're going to eliminate that fearful response and you're going to eliminate greed because you already have an exit plan. Now, really, and the other big emotion is FOMO. FOMO is really it's kind of a mix of fear and greed. And to be honest, this is probably the biggest thing that will blow up your account. Oftentimes what happens is, a breakout has happened, a pivot has happened, something's run up 20, 30%, and then people start thinking, oh man, I already missed it. I need to, it's going to run even higher. The problem with this is there's already a ton of sellers and they're probably ready to take profit. And what you're doing is you're actually just buying their profits and you're just kind of bag holding. And, GME was a good example of this. AMC was a good example of this. Pretty much any breakout when you're chasing it is a good example of bag holding. Now, I'm not saying that trading AMC and GME was incorrect. Actually, I actually think they were great things to trade. I'm a breakout trader. I actually love things that have momentum like that. But the thing is, you need to get in early and define your risk early. As long as you're defining the risk and coming up with a good risk reward, then it's a beneficial trade. The problem happens when you start trying to chase trades, and that's usually as a result of FOMO. You have to remember, the market is always going to give you another opportunity. Every single day there'll be another opportunity. And, even if there's no opportunity for a week or 2 weeks, at some point, if you're patient enough, there will be another opportunity. The money is actually made in waiting. The money is not made in clicking the buy button. It's actually made in just waiting and being patient for the next opportunity to present yourself. So if you find yourself being antsy or not taking a trade, just take a step back. Your goal is not to get into trades. Your goal is to get into profitable setups. And that actually brings me to my next point, number 4. Most people, when they make a trade, they have one way to evaluate that trade. Now let me ask you, if you made a trade, how would you decide whether that was a winning trade or a losing trade? Pause the video and tell me in the comments below what you would consider a winning trade and what you would consider a losing trade. Now, most people, what they'll tell you when they're new traders is a winning trade obviously is one that makes money, and a losing trade is obviously one that loses money. This honestly couldn't be more far from the truth. A winning trade is not necessarily something that makes or lose money. A winning trade is one in which you identified a high reward to risk setup, risked an appropriate amount, and followed your trade plan. Regardless of whether or not that position made money, if you entered the trade based on your trade plan, it was a winning trade. And even if that trade lost you money, I would say you did a good trade, you made a wonderful trade, and you should keep doing that. Because in the long run, if your trade setup has an edge, you just need to keep having more and more iterations to get enough instances to become profitable. Let me take a step back. There's something called process-oriented thinking versus goal-oriented thinking. Winning traders have process-oriented mindsets. They don't necessarily care about making or losing money. I mean, obviously, at the end of the day, they want to become profitable traders, but in the beginning and towards the middle of their journey, they know that you need to focus on the processes and learn a skill set, and that is how you become consistently profitable. If you're always focusing on the money, losing money, or making money, you're going to make bad decisions based off of the wrong things. Take a look at this infographic. So on the left, you have, a process-oriented person will say, oh, I made a good trade, followed my trade plan, but it didn't work out. Oh, that's too bad. I'll get it next time. Oh, I followed my trade plan and I made money. Great. I know I'm doing something right. Let's keep doing that. On the flip side, a goal-oriented thinker will say, oh, I lost money. This obviously must be a bad trade. Or, oh, I made money. It obviously was a good trade. Now, let me take you back to that example when I bought those Apple leaps. So, I had 700 shares of Apple essentially on an earnings play. And that was about half of my account. If Apple happened to gap down, which is pretty much a 50-50, it's really impossible to tell when a stock is going to gap up or down. People can speculate, but no one can ever actually know. Now, if it gapped down, I would have lost 50% of my account. If it gapped up, I would have made 50% of my account. Now, as soon as I made that trade, I already knew I made a losing trade. Regardless of whether or not I made money, I already knew that either one, I'm going to get lucky, or two, I'm going to pay the price because I didn't appropriately manage my risk. Now, what ended up happening is I actually got a little bit lucky, and I only lost about $2,000, which in the grand scheme of things didn't blow up my account, and it was a huge loss for me. It kind of took away my entire year's profits, but it gave me a powerful lesson, and I've never made that mistake again, and I really, really learned the hard way about risk management. Number 5, always looking for the easy way out. When you're a new trader and you start to open up a trading platform, start to look up YouTube videos, start to search Google, you're going to get hundreds, if not thousands, of ads about how to become the next millionaire day trading or swing trading or whatever it is. Now, I'm sure there's some courses out there that are legitimate, probably 1% to 2%. Pradeep is actually one of the better guys out there. I personally like his strategies a lot. He's got a lot of free content though, and so check that out first. Kristjan Kullamägi, all of his content is free, and he's an inspiring trader to me. And BlackBox is a huge community that I've learned so much from. You have to put in the work. They're not just giving you trading alerts. They're teaching you the process of how to become a winning trader. Now, if you just keep trying to find a place that will just give you 1 or 2 alerts a day, or buy this, sell this, buy this, sell this, you're never going to become a profitable trader. Now, if you really want to become a consistently profitable trader, you need to put in the work. It doesn't sound fun, it doesn't sound glamorous, but at the end of the day, trading is a profession just like anything else. Let me just show you this infographic here. There's a common misconception that happens when people new to trading first learn a little bit of information. It's called the Dunning-Kruger effect. Whenever someone learns a little bit about a new topic, they think they're a genius. That little bit of knowledge, they went from knowing nothing to knowing a significantly large amount more. The problem is, it's probably just a percentile of the information out there. But in their mind, they are infinitely more knowledgeable, and so they think they're a master already. So when you don't follow the things that we already talked about, like risk management, focusing on the results, and not having a trade plan, you're gonna blow up if you just enter a position and go all in. So let's recap. 1, control your risk. 2, have a trade plan. 3, control your emotions. 4, focus on the processes, not necessarily the results. And 5, put in the time and don't look for the easy way out. That's all I got for you guys. I hope you enjoyed, and I'll see you guys in the next one.